policy. So joining us now for more is Michael Kantrowitz. He is Piper Sandler's chief investment strategist and head of portfolio strategy. Michael, thank you so much for joining us. Obviously, a lot of headlines to go through today. As Brian suggested, we are waiting for another executive order. We don't have it yet. We don't yet know, obviously, the full details. But markets paying attention to what's going on in D.C. How should you be positioned right now when really there are so many unknowns?
Yeah, absolutely. And we've been recommending investors remain balanced in generally larger companies with better, superior fundamentals that can remain resilient in this backdrop of uncertainty, high price levels, and interest rates that I think are going to remain sticky for some time. So, the market continues to get whipped around in terms of what it's focused on. Up until this morning, it was interest rates, and now it's back to tariffs. And that will likely be the case until the next catalyst shifts the narrative once again.
Obviously, we pay an awful lot of attention to the equity market, but the bond market has been sending us signals for quite some time. And some folks look at that as really where our eyes should go first. What are your expectations for what we're going to see on yields? I think there was a period of time where we thought we're not going to go past 4. And clearly, we are well past 4 at this point.
Yeah, well, I think what took us higher from late September or mid-September of last year was largely that the employment data got a lot better in the U.S. after softer employment data in the middle of last year. So the economy got better, economic surprises improved into the beginning of this year, and that took rates back up. And then, of course, we had all the volatility from tariffs. And now you've got quite a bit of a mixed picture. Inflation, on inflation, you've got oil that's at very low levels. And you've got some high-frequency inflation data like prices paid on manufacturing at very high levels due to the higher tariff numbers, even that haven't fully reflected the drop in China tariffs. So there's a very mixed picture from inflation. In terms of growth in the economy, that's really about employment. And the last 2 employment reports have been fine. I expect the next 2 employment reports to be fine. So I think yields are kind of going to be where they are. I don't think the deficit issues, or at least in the U.S., I would point to Japan's 30-year bond yield, which has been probably carrying the global yield higher as a bigger issue than the U.S. deficit.
It's so interesting. You bring up such good points, which we talk about often, the difference between what we're seeing in the hard data and the soft data. So things like employment, that looks pretty good. But then consumer confidence, that doesn't look so good. The psychology certainly plays a big part in investing. And to be honest, I am somewhat surprised that the markets are only off the major indices by about 0.5% on these new potentially threatened tariffs from President Trump on the EU or Apple phones specifically. Is the market just starting to sort of shake off some of these headlines as, look, this is sort of the initial warning shot across the bow. We're not actually going to see those numbers. Is that a fair assumption or a dangerous assumption to make if you're trying to deploy capital in this market?
I think that's a fair assumption. Again, we have EU tariffs to get through, and then product tariffs and semiconductor tariffs that are still coming. So there's a long tail of uncertainty with respect to Trump's tariff agenda, and he clearly, again, does want to have these tariffs in place. I don't think anyone believes that we're going to see a 50% tariff stick in Europe. And I think given the recent behavior in early April, the market's maybe perhaps calling Trump's bluff or perhaps a little bit more desensitized to it and thinking of where we will end up, not necessarily the path we'll take to get there, which is how the market acted back in early April.